Support for today's episode comes from Amazon. Amazon is working toward a carbon free energy future, doing more with less, investing where it matters most, and supporting communities where we operate. The return of the physical economy, trade tensions, AI infrastructure growth, and resource constraints are forcing executives to rethink assumptions about supply chains and competitive advantage that held for 2 decades. The past 2 decades rewarded organizations that optimized information, software, and global sourcing. Increasingly, competitive advantage is shifting back towards something more fundamental: access to physical resources. Trade disputes, critical mineral shortages, energy constraints, and AI infrastructure expansion are exposing dependencies that many organizations spent years treating as operational details rather than strategic assets. What once appeared to be temporary disruptions are increasingly looking like permanent features of the operating environment. AI infrastructure growth is straining material and energy supply chains simultaneously. Data center expansion offers a clear illustration of how physical constraints are reasserting themselves. Global electricity demand from data centers grew 17% in 2025, while demand specifically from AI-focused facilities surged 50%, according to the International Energy Agency, IEA. That growth is compressing supply chains for energy, construction capacity, and critical minerals at the same time. The IEA noted that by 2030, data center build-out could account for roughly 2% of global copper and silicon demand, over 3% of rare earth element demand, and more than 11% of global gallium demand. Those same minerals underpin clean energy equipment, defense systems, and advanced manufacturing. The competition for them is not hypothetical. China's export restrictions on gallium, germanium, and antimony, imposed in late 2024 and extended through 2025, caused gallium prices outside China to more than double within 5 months. Organizations that assumed stable access to these inputs are now navigating a market where the assumption no longer holds. Resource access is becoming a strategic variable, not a procurement detail. Julia Binder, professor of business transformation and director of the Center for Sustainable and Inclusive Business at IMD Business School, has argued that circularity has evolved from a waste reduction tactic into a strategic driver of business value, helping companies secure resources, manage risk, and deliver superior customer outcomes in an increasingly volatile world. The framing matters. This is not a sustainability argument. It is an argument about control. In earlier work with IMD's Simon Evenet on sustainability and geopolitics, Binder identified what they called a resilience trilemma. Global supply chains that were built to optimize for efficiency and cost have been made fragile by the erosion of trust, the fear of supply disruptions, and the concentration of critical resources. Once governments start worrying about continuity of supply, the economics of how organizations source, recover, and hold materials change fundamentally. That is the environment executives are operating in now. Circularity as a supply chain hedge, not a sustainability program. Some organizations are already repositioning circular economy initiatives within this frame. Material recovery, component refurbishment, and closed-loop supplier partnerships provide something specific: greater visibility into resource flows and reduced exposure to volatile spot markets. That is a different conversation than reporting metrics or scope reduction targets. For procurement and operations teams, the practical starting point is not a business model redesign. It is a more disciplined accounting of where critical dependencies actually sit. Several organizations are conducting assessments of material exposure, supplier concentration, and resource vulnerability to identify where future constraints may emerge before they become cost events. What was once filed under sustainability planning is becoming standard risk management. The broader pattern is worth naming clearly. Capital remains important. Technology remains important. But as the IMD analysis on sustainability and geopolitics observed, access to energy, infrastructure, materials, and trusted supply networks is increasingly determining which organizations can execute on growth plans and which cannot. The organizations that internalize that shift earliest are treating physical resource access as a board-level question. Those that have not are finding out the hard way that their assumptions were priced for a different era. Sustainability Soundbites energy coverage is sponsored by Amazon. Visit the link in our show notes to learn more about Amazon's Spotlight on Energy. For sponsorship opportunities with Environment and Energy Leader, please reach out to a member of our team.